Ladies and gentlemen, Matthews here from MnFFOREXTRADERS. I'm here with another beautiful video for you guys. This is going to be a presentation on trading psychology. So here, this is what I was supposed to look out for. So we're going to talk about the emotional things that actually traders go through, all those psychological barriers that most traders go through, and how we can actually solve them in order to in order to become the consistent, profitable traders that you want to become. All right, so sit tight, grab a pen and a paper or a book somewhere so that you can be able to write these important notes that we're going to actually talk about today. All right, so let's go. So, what is trading psychology? What does trading psychology mean? Well, trading psychology is a broad term that includes all emotions and feelings that a typical trader will encounter when trading. Some of these emotions are helpful and should be embraced, while others, like greed, fear, nervousness, anxiety, should be contained. Why trading psychology? So, if you've been trading for a while now, you must know how important trading psychology is. You must have realized how much trading psychology is important, right? So let's talk about it. So trading psychology is the number one reason why most traders lose their money. About 95% of traders lose their money because of trading psychology. So most traders don't handle or control their emotions or fail to control their emotions. Therefore, they end up blowing up their account. Yet it's the least talked about. Everyone else is trying to find the next big thing. Everyone else is trying to find that holy grail strategy that will not lose, right? But the truth is, all systems undergo a losing period, a losing streak. That's part of the game. I'm sure you know that by now. And we are supposed to stick to our systems even during those periods, all right? Provided we have backtested and forward tested our strategy, and the strategy has shown positive expectancy over a series of trades, right? Of course, not one trade or five trades. We're talking about a series of trades. Talk about hundreds of trades. You have done your backtesting and it has shown that it will be profitable over a series of trades. Therefore, the only thing that you need to be doing is being consistent with your system or your trading plan. Follow your trading plan every time. For you to have that edge play in your favor, you have to be consistent, right? You have to be very consistent, all right? So you can have a great system with a great positive expectancy, but if your trading psychology sucks, you will never make any money in this market, all right? That's how important trading psychology is, guys. You can have a base setup right there. You can have a base strategy out there. But if your trading psychology is not in order, if your emotions, you're not controlling your emotions, you're not managing them, at the end of the day, you end up giving back all the money that you've actually made. Why? Because you reach a level where when you take a loss, you start to panic, you start to make emotional decisions, which will actually end up costing you all that money. All right, let's go. So, what are these emotions? What are these common emotions that most traders go through, or most typical traders will actually undergo? So, in this particular presentation, I'm not going to talk about all of them, but I've chosen to talk about three most important emotions that most of us go through, right? So, the number one emotion is greed. All right. So, what is greed by definition? Greed is just a selfish and excessive desire for more of something. So, in our case, more money, right? We want to make more money. Number two, it's an unpleasant fear, which is number two, which is an unpleasant emotion caused by a threat of danger, pain, or harm. So, fear is an unpleasant emotion caused by threat of pain or harm. Okay. And number three is an ego. Ego. What is ego? It's a person's sense of self-esteem or self-importance. All right, that has self-esteem. You feel like you're very, very important and you cannot do this, right? So let's go. So, how do these emotions affect our trading? How do these emotions affect our trading? So we'll start with greed. So like we've defined, greed is it's a selfish, excessive desire for more of something. So in our case, we're talking about money, right? So this is very common in all traders because as traders, we're all here to make money, right? But however, greed creeps in and causes you and I to want to make more money on a particular trade, either by using a bigger position size or entering multiple trades at the same time, or by holding a trade longer past your target, hoping that the trade will continue to go in your favor, and that's when you know you're becoming greed. Of course, sometimes this will work in your favor, but again, the day will come when it goes against you and you blow your whole account. That's why we should always follow our plan and have a trading plan and stick by it. All right, because at any particular time, anything can happen, and you don't want to find yourself in such a situation. Whoa. So when it comes to greed, you see most people, especially this is very common, where you've seen a lot of people trying to take multiple positions on a particular pair, all right, with hope that the trade is going to actually go in their favor so that they can be able to make a lot of money in that particular trade, right? But what most people forget is that anything can happen in these markets, right? Anything at any particular time, anything can happen. That good winning trade can out of nowhere turn around and start to go against you. And imagine you've taken 10 trades of that particular pair. Immediately the trade starts to go against you, you start to freak out, you end up closing the trades, or would you have hope, right? Thinking that the trade is going to reverse and the trade keeps on going against you. And once that happens, you start to panic, you start to have you become anxious, you end up probably closing the trades too early, right? Why is that happening? It's because you've not accepted and internalized the risks. All right, it's okay taking two trades when maybe you're risking 2%. Take 1% on one particular trade and take another percent on another particular trade. But what most people do is that they don't even actually factor that in. What they do is they just want to make money, therefore they'll just hit sell or buy. They end up blowing the account once the trade goes against them. Well, most of the people, they won't show you the negative, right? They only show you when that setup has actually gone in their favor and they've made money. To show all blue like that, but they never show you when the market has gone against them. Why? Because they can't do that, right? They don't want to do that. So that's the bad part. They don't show you. They'll only show you the positive part. All right, so it's important for us to be able to actually take charge of our greed, because at the end of the day we all want to make money. But in this industry, ladies and gentlemen, anything can happen. Therefore, we have to be able to control our greed. All right, using bigger position size compared to your whole account. Why would you use a bigger stop loss? I mean, a bigger lot size relative to your account. You want to make money. However, once the trade, that particular trade starts to go against you, you either quickly take out, quickly get out of the position, or once it goes against you, you lose big. Why? Because you've not predefined your risks. Therefore, immediately it starts to go against you, you freak out and you actually get out of the market. Probably that retracement was just a small retracement before prices would continue going down in your direction, right? And then you'd end up actually getting out of the market because you didn't predefine your risk in the first place. So you always have to make sure that you predefine your risks, know exactly where you want to be taken out from, and don't know exactly the amount that you are actually risking on that particular trade. So how can we solve these problems that comes to that comes due to greedy? Number one, so have a clear written down plan, trading plan on how you're supposed to trade and follow it religiously. Plan your trades and trade your plan. Number two, have a strict entry, target, and trade management rules that you follow. Predefine your risk every time and let the market do the rest. And number four, follow your plan. I know this is quite mouthful, but this is very important, ladies and gentlemen. You always, before you actually start trading, before you think of placing any trades, you must have a trading plan. First of all, you must have a trading system, and that trading system that has your plan in it. It has your risk management plan. It has your um, strict risk management plan. It has your trading psychology and your strategy. Everything is supposed to be there, and you're supposed to actually follow that every time. You should know when you're supposed to enter into a trade. You should know when the market, how to manage your trades when it's going in your favor, and you should know exactly how to manage your trade when it's going against you, right? So you should have that in place. If you don't have that in place, please stop trading and make sure that you do that. And once you actually have a plan, you have an edge in the market, then every time you are going to enter into any particular trade, make sure that you predefine your risks every time. Let's go to the next. Fear. So, fear. Fear, an unpleasant emotion caused by a threat of danger, pain, or harm. So, by now you should know that the outcome of any particular trade is purely random, right? As a retail trader, you have no control over outcome. No one knows with certainty that a trade is going to be a winner. Otherwise, would have been risking our whole account on a single trade. That's why we use stop losses, right? Because if we knew that the particular trade I was actually going to go in our favor, would have been risking our whole account. But no one does that. Unless if you have a $50 account or a $100 account and you're ready to risk it, all right? Yeah. And for somehow we understand on a superficial level, but we fail to follow it through. We know that at any particular time, any trade can go either way. It can be a winner or a loss. We understand that. But we don't want to actually implement that and use proper risk management and internalize that and actually accept that anything can happen. If you understand and actually understand that anything can happen, then why would you be afraid? Why would you be fearful if you actually understood that at any particular time anything can happen? Why would you be scared? Right? So now that you know that, you don't know what will happen on any given trade by any given time, right? You don't know what's going to happen at any particular time, but you have a strategy that has shown positive expectancy over a series of trades. Why are you still fearful? Meaning your job only becomes to execute because you know that over a series of trades, you're actually going to be profitable. You don't have to be fearful because you know that probability will take care of itself. So somehow you're fearful because somehow you think you know what's going to happen, and you actually think that maybe this trade is going to be a winner. Maybe this trade is going to be a winner. You're trying to pick and choose trades. Ladies and gentlemen, you have to let go the outcome based mindset and adopt a process based mindset, right? Don't judge yourself from the result of a trade because you have no control over that. Instead, judge yourself on how well you executed that particular trade. That's what you have control over. Most of us are so focused on how much money we want to make, how much money we can make. and a few of us are actually focused on process, on the process. How are you making sure that you are taking the right setups every time? How do you make sure that you are always identifying and objectively identifying your edges every time? That's what you have control over. You have no control over what's going to happen on that particular trade. You have no idea what's going to happen, right? You have no idea. Therefore, what you can do is, and the only thing that you have control over is your process in identifying your setups. So you have to do that objectively. Number two, you have to predefine your risks every time before you enter any particular trade, because at any particular time, anything can happen. Anything can happen, ladies and gentlemen. So you don't have to be fearful because you don't know what's going to happen. If you find yourself in a winner, you're not any smarter, right? Probability was in your favor. And if you lose, you're not any dumber. Probability was just against you. But however, if you have a system in place that has shown positive expectancy over a series of trades, then you don't have to be afraid anymore, because you have no control over that. Anything can happen at any particular time. So the only thing that you can do, ladies and gentlemen, is learn how to execute flawlessly. You should learn how to execute flawlessly, making sure that you are doing your part nicely. Make sure that your part is done flawlessly, and let the market do whatever it wants to do. But over a series of trades, assuming you have an edge, you're going to be profitable. That's how it works, ladies and gentlemen. Let's go to the next. So, how do we solve the fear problem? Like I've mentioned previously. So, you have to understand and internalize the fact that you have no control over any outcome of any given trade. You have no control over that. You have no idea what's going to happen. However, you have an age. I'm assuming you have an age, right? So if you don't have an age right now, make sure that you follow us via those links in the description. Come, we teach you our age. Our age has shown positive expectancy over a series of trades with massive risk reward ratio. All right. So if you have an age, and you understand that over a series of trades you'll be profitable, right? You're going to, as long as you have an age, you're going to be profitable over a series of trades, not on that particular trade, not this trade, not that trade, but over a series of trades, right? So if you don't have an age, please make sure that you do that. All right. So stop looking for a holy grail with that 90%, 99%, 100% win rate that is advertised out there. You won't find it. All right. However, if you have started with 45% or even 30%, actually, even 30% win rate, you're still going to be okay, provided you have a good risk to reward ratio. So if you have anything from 30 to like 70% win rate, then you're just okay. Just focus on executing, finding those good setups. And once you find those setups, execute flawlessly. Follow your rules. Over a series of trades, you are going to be okay. And I know it's not easy. It's not easy. The emotions will come. The emotions will come and actually cause you to actually exit a position too early. All right, the trade is going in your favor. You are afraid that the trade might come against you and lose those profits that you've actually gained. I know those will come through. So that's the reason why you actually have to actually understand these things, right? So focus on executing your edge and follow your edge every time. You have to do this, ladies and gentlemen. Number three, you always have to predefine your risk and use a position size calculator in order to determine how much you should use on any particular trade before actually taking it, and make sure that you are risking only the amount that you're actually willing to lose, right? On any given trade, make sure that you are risking between 1 to 3% of your account, even less than 1%. The key is to make sure that you are actually comfortable risking that amount on that particular trade, so that you can sleep at night, so that you don't have to be checking your phone every time, right? So how do you know that you are using a bigger lot size? You are always going to be checking on your phone. I've done that, right? You won't sleep well. I've done that, right? So make sure you learn from that. Use the correct lot size for your emotions that your emotions can handle, so that you can sleep well at night. Okay. Number 4, know your age and remain consistent. Probably, maybe some of you don't know what I mean by when I say an age. An age is simply your strategy. You should know your strategy better than anyone else and be able to consistently follow it, such that whenever the market shows you your age, you should not even hesitate. Jump into that particular trade as soon as you have your confirmation, right? Because you will never know which trade is going to actually be a winner. You have no idea. And if you think you know, you're just lying to yourself. Stop lying to yourself. Because at any particular time, the market is going to go against you or in your favor. That's how it is. All right. So make sure that you actually understand how much you're risking, the dollar amount of how much you're risking on that particular trade. Focus on executing. All right. And if you don't have an edge, make sure that you find an edge. Find an edge that is a strategy that you are going to be comfortable with. Something that you can actually trade and you're really comfortable with it. That's what you're supposed to look for. All right. So that's how it is. So let's go to the next. The next is ego. This one is big, ladies and gentlemen. This one is big. Most of us are very competitive. We don't like losing, right? We don't like losing. Losing is looked at as bad. So therefore, when a trade goes against you, you try to give it more space. Let me just move my stop loss a little bit higher. Maybe it's going to reverse. Maybe it's going to reverse. Before you know it, you are negative 2% of your account, 3% of your account, 4%. The loss will keep on becoming bigger, and hope comes in. Ladies and gentlemen, hope is not a strategy. Immediately the market comes to your stop loss, let it take it out. That's the role of a stop loss. Two things. A stop loss should be able to protect you from losing a lot of money. Number two, it should help you invalidate your trading setup. It should help you to invalidate your trading setup. Those are two things that a stop loss should actually help you with. One, help you from losing a lot of money. Number two, it should help you with invalidating a setup. So once the market comes to my stop loss, I'll know that the market has actually come to my stop loss and this setup is no longer valid. Therefore, I'm out of this market because it's no longer serving my purpose. The moment you fail to actually accept the loss, just know that you have ego problems. Okay? You have ego problems. You must accept losing. So, what is ego? Ego is a person's sense of sense of self-importance or self-esteem. Okay? So our mind was programmed to hate losing. Remember, growing up, losing was looked at as being bad, and as being winning was looked at as being good, right? Therefore, we did everything in our power in order to actually win, right? For example, in sports, basically, we are we actually have some sort of control over winning. All right, we know when we do these things, we are most likely to win, right? Therefore, we have to train harder and do all that. But when it comes to trading, we have no control over winning. All right, we have no control over winning. So when in the past, when we do these other things, when we train hard, when we do these other things in the industry where we actually have control over winning, we have power over winning. Therefore, we can do everything in our power in order to win. Okay, and that can work. But if you bring the same mind, the same brain to trading without it being trained to think in probability, you end up blowing up. You will blow up. Okay? Why? This is because in trading, we have no control over outcome. We cannot decide to win. We cannot make a decision in order to win. What we just need to do is to execute our edge every time it appears. Okay? And that is really hard, especially if you are used to have control over outcome. So therefore, we have to shift our mindset into thinking in probabilities. Okay? You have to shift the thinking. If you ever want to actually achieve consistency, you have to shift from trade by trade basis to actually thinking about series of trade basis, because at any particular time, whenever we enter into a trade, we have no idea what's going to happen. So every time you enter into any particular trade, that money that you're risking, just count it as lost. You've already lost that money, because at any particular time, that trade can actually go against you. Okay? So that's how it is. So you can do everything right and still lose, and you can still do everything wrong and still win and make money, and make some good money actually. Now that only enhances the bad behavior, which will cost you later on. So you have to accept that you are wrong when the market comes to your stop loss. Take the stop loss, take the loss, and move to the next trade like nothing happened. Accept the loss and move on. You have to learn how to do that, and you can only do that when you are actually predefining your risk. You know exactly how much you're risking on a particular trade, and if the trade goes against you, you know that this is how much I was risking, and I'm okay losing this much. But the problem is that most of us don't define our risks. That's the reason why we get to be anxious, we get to be fearful, right? Because we've not accepted the risk. And if made the stop loss, I mean, the market comes to a stop loss, you try to move your stop loss higher, try to give it space for the market to actually reverse. Hope is not a strategy. Immediately the market comes to your stop loss, get out of the market. There are millions, thousands of opportunities in the market. You just need to keep looking. There's no need for you to be glued to that particular trade setup. If it has failed, go to the next one. Execute. Execute. That's the key, ladies and gentlemen. That's the key. So how do we deal with this problem? Like previously I've said, you have to have a clearly written down trading plan on how you're supposed to trade and follow it religiously. Plan your trades and trade your plan. Number two, have strict entry, target, and trade management rules. Predefine your risk every time and follow your plan. And when the market hits your stop loss, it just tells you that the setup has been invalidated. Go find another trade, and it's not a reflection of you as a trader. No. For as long as you followed your rules, you are okay. Just need to continue executing. Listen, like I've said previously, even a great setup can fail. So provided you have followed your rules and you have a strategy which you have back tested, and over a series of trades it has shown positive expectancy, you are okay. You are all right. Just continue to follow your strategy. Okay? Just continue to do that. So for example, I can actually tell you how we actually manage our trades, right? So for example, if my target is 100 pips, the market has to go in my favor, and if it goes in my direction about 25 pips in profit, I'll move my stop loss to break even or slightly into profit. Okay, and also make sure that I'll only move my stop loss when the market also has broken the recent higher low. That's if the market is going up. That's if I'm buying. And if I'm selling, I'll look for the market to break the recent lower high. And just like that, I'll keep trading my stop loss behind structure. That's how you manage the trade. And you are supposed to follow that every time you're actually trading for you to actually be the consistently profitable trader that you want to become. So you have to be consistent as a trader as well. All right. So this is very, very important, ladies and gentlemen. Let's go to the next so that we actually talk about these most important beliefs and core beliefs that you're actually supposed to actually live by. All right. So these are the 5 fundamental truths of trading by Mark Douglas. This is very, very, very important. I know I've made videos about this, but I just wanted to add them into this presentation for you guys. So number one, anything can happen. If you understand that anything can happen, therefore you have to make sure that you stick to your rules. Know exactly how much you're risking on a particular trade and do everything in your power to make sure that you're doing everything. Because at any particular time, anything can happen. Number two, you don't need to know what's going to happen next for you to make money because you have no control over that. You have no control over what's going to happen next. And you don't need to do that for you to make money. You just need to execute, execute, and execute. Number three, there's a random distribution between wins and losses for any given set of variables that define an edge. There's a random distribution between wins and losses for any given set of variables that define an edge. Just because you have a 70% win rate, it doesn't mean that you are going to have 3 losses in a row and 7 wins in a row. It doesn't work like that. Just because you have the 30% win rate doesn't mean that you're going to have 3 winning trades in a row and 7 losing trades in a row. It doesn't work like that. So these trades will come randomly, provided you stick to your strategy and execute consistently. You will have your win rate. Okay, so there's no need of you stopping to trade just because you've had 5 losses in a row. There's no need for you to start complaining just because you have 5, 6 trades losses in a row, right? Execute because there's a random distribution between wins and losses. For you to actually, for you need to give time and chance for your edge to play out. Your edge won't come like that. You won't have those consistent wins that you're looking for. You're going to have probably two losses in a row, then you have your winner and another winner. Probably you can have those winning streak. Okay, you can also have those losing streaks. It's about probability, ladies and gentlemen. You will never know which trade is going to win. You have no idea. No matter how much you try to actually predict the market, you will never know which trade is going to win. Therefore, as long as that setup meets your criteria, it has your edge. Take the trade because if you say, "Now I just took 3 losses in a row. Let me don't take this one." That's the one that will become a winner. So make sure that you follow your rules every time. Number four is an edge is nothing more than an indication of a higher probability of one thing happening over another. Listen to that again. An edge is nothing more than an indication of a higher probability of one thing happening over another. Okay, this is your strategy. And this happens over a series of trades. It's just an indication of one thing happening over another, a higher probability of one thing happening over another. No guarantees. No guarantees that this trade is going to win. That's the reason why you're supposed to execute. You are supposed to be concerned with executing because it's over a series of trades, not just one trade. Number five is every moment in the market is unique. Every moment in the market is unique. Just because I had a great setup in the morning today and I see the same setup in the afternoon doesn't mean that that setup is going to work. Because at every particular time there'll be different players in the market, and at any particular time anything can go wrong. Because everything in the moment in every moment in the market is unique. So you cannot say I had this winning trade yesterday, it was the same, it was at this particular level, I know it's going to go in my favor. You take a trade and that's the same trade it can actually lose. So you have no idea what's going to happen. So just execute. So I recommend that you print this out, stick it on your trading desk. You have to read this, make them your mantra. All right, read them over and over until you can actually truly believe in them. All right, study them so that you can believe in them. Before you start trading in the morning, go through these things, because they will actually make you a better trader. All right, they will reduce those emotions that you're facing, the anxiety, the fear, okay, the greed. Because you can't be greedy if you know that at any particular time anything can happen. You cannot over risk when you know that at any particular time anything can happen. You cannot do that. You can't. You cannot try to actually put so much on a particular trade uh, while knowing that every moment in the market is unique and at any particular time anything can happen. You cannot do that unless you're not really thinking properly. Okay, let's go. The 7 principles of consistency. I love these. These are my favorite. Number one, I objectively identify my edges. Just like the previous ones, you're supposed to have these on your trading desk. Read them on a daily basis until you really actually understand and internalize them and they are part of you. Okay, so number one is I objectively identify my edges. Number two, I predefine the risk of every trade. Number three, I completely accept the risk or I'm willing to let go of the trade. Let me repeat number two. I predefine the risk of every trade. I've preached this several times. So before taking any particular trade, you're supposed to predefine, know exactly how much am I risking on this particular trade. What you're simply saying is, how much am I willing to pay in order to find out if this trade is going to be a winner? That's what you're supposed to be looking at it. You're supposed to be looking at it in that perspective. How much am I willing to risk on this particular trade to find out if it's going to win? And you're supposed to be comfortable losing that amount of money. And you're supposed to know the dollar amount of a particular risk. Don't just say 2%. Know exactly how much is your 2%. How much is it, so that you know when a trade goes against you, be like, I knew I was going to lose the $10. I knew I was going to lose the $100 on this particular trade. So I'm okay with it. I'll move on to the next trade. So you have to accept them like that. Number three, I completely accept the risk or I'm willing to let go of the trade. Deep. This is deep, ladies and gentlemen. You have to accept the risk or be willing to let go of the trade. There are some times when you actually analyze already and the market actually has moved a little bit from your entry. Okay, it's going in your direction and you are out of the market at a particular time. You find that the market has actually gone a little bit in your favor. So you either accept the risk because the market has moved in your favor a little bit, meaning the stop loss is going to be a little bit higher. So you either accept the risk or let go of the trade. Number four, I act on my edges without reservations or hesitation. This kind of confidence only comes when you have a strategy which has shown post expectancy from backtesting and forward testing. You cannot have this kind of confidence if you have no strategy that works. You cannot act on your edges if you don't have a strategy that you've actually backtested. So you have to have a strategy that you actually have back tested and forward tested, and over a series of trades, it has shown positive expectancy. Then you have to act on them. You have to act on that age whenever it appears, whenever the market appears. Whenever the market shows you your age, you're supposed to act without reservations, without hesitation. Number 5, I pay myself as the market makes money available to me. You have to pay yourself as the market makes money available to you. There'll be times when the market goes in your favor, and then all of a sudden it goes down to take you out. Okay? The market doesn't move in a straight line. So just because you have a nice setup, the market is going in your favor, and doesn't mean that the market will continue to go in a direction. At any particular time, ladies and gentlemen, anything can happen, like the first one here. Okay, so you have to pay yourself. Make sure that when the market goes in your favor, keep trading the stop loss. Pay yourself. That's paying yourself. When the market goes in a direction, move your stop loss higher every time. Don't move your stop loss too early. Have a system in which you actually manage your trades. Number 6, I continually monitor my susceptibility for making errors. We are emotional beings. We are emotional beings. Okay? You cannot expect to trade properly when you just had a quarrel with your spouse, or when you're not feeling well. You cannot actually do that. Therefore, you need to know when you're supposed to trade and when you're supposed to take a break. Knowing that will prevent you from losing money unnecessarily. Know when you're supposed to trade. Know when you're feeling good to trade. Okay? So don't just trade every day just because you want to make money. Know when you're feeling too low to trade. You should know it. Know when you're feeling too hyper to trade. Okay? Because you'll be making emotional decisions. And in this market, emotional decisions will make you get burned. So don't do that. Number 7, I understand the absolute necessity of these principles of success, and therefore I never violate them. I understand the absolute necessity of these principles of success, and therefore I never violate them. This is big. This is big. So you have to actually have this on your desk, sign, put your name there and sign, so that you actually uh, take that ownership and actually follow your rules every time. Mark Douglas did a very, very good job on this. Please make sure that you read Trading in the Zone and Disciplined Trader. Those are wonderful, wonderful books on trading psychology and risk management. They will help you very much. So, summary. We know we know that our inner, as traders, we know our own inner emotions, and we need to make sure that we deal with them off the market. Don't try to make quick money in forex. If you need quick money, get the job so that you can actually raise good capital so that you can come and trade at the level that you want to be trading at. If you over risk, eventually you get banned. Okay, even great setups fail, like I've always said. So in order for you to find yourself in a winning trade, in a good winning trade, you have to make yourself available when that winning trade comes along. In the meantime, you just need to endure those small manageable losses. Okay, you have to endure those losses will come. Those small losses are going to come. So the only thing that you can do is manage those small losses. Manage those small losses, because at any particular time you can find yourself in a good winning trade. So in order for you to actually find yourself in that good winning trade, you have to be available. Okay. So most people, when they take 5 losses in a row, they'll be like, nah, let me just uh sit back and relax. Let me just maybe, and you realize that the next time the trade appears, that's the one that's going to be a winner. So you have to make yourself available when that winning trade comes along. And then the books that are, like I said, the books that I would like you to read, the ones that I recommend to read on psychology. These are the 2 books: The Disciplined Trader by Mark Douglas and The Trading the Zone by Mark Douglas. All right. So, ladies and gentlemen, I hope to find some value in this. Okay. If you have, make sure that you subscribe, like the video, comment in the comment section. Let me know what you've learned from this video. And also give me suggestions of what kind of video you'd like me to make next. Okay, thank you so much for watching. God bless you. Until next time, goodbye.